Hello and welcome to Crypto Weeklies. In this video, we are going to discuss about Doge. None of the content is financial advice. This Doge USD, where the composite risk per hour analysis or interpretation of composite risk model across all of our major risk-based models related to crypto. The composite risk related to Doge is now less than 0.185, so it's in this green zone. So just looking to analyze what are the individual components of these model. If the risk for Doge accumulation has bottomed for the 2026 bear market. Starting with this overall composite risk indicator, you can check it out the full report over here by clicking this, or you can hover down over here. The point 185 comes from the deviation, the 20 almost one fourth of it comes as a result as comparing between the price and the regression based fair value, the time weighted average price based deviation, 20-week simple moving average price based deviation, almost 60% or little under two-thirds of the score is assigned using those metrics. Then 24% roughly speaking, 24-25% roughly speaking, coming from the drawdown from the all-time high related discussion and volatility related interpretation of how the standard deviation of the returns are impacting the score. And the last few percent comes from the beta and the Sharpe ratio correlation with the S&P 500 and the risk adjusted return uh, based risk. So all in all, as Doge is at around 0.815, sorry, 185 risk, so it is less than zero point 0.3 risk, which is typically an area to consider before the accumulation. So now if we go to the price of Doge, it's currently less than or currently close enough to 10 cents. The price is lower than the 200 week simple moving average, which is at around 13 cents. Whenever this blue line turns into white line, that's where the price is lower than the 200 week simple moving average. And if you look at some of the best times to DCA Doge, you would find that below 200 week simple moving average is is not the worst zone to do that. That doesn't mean that the price does not go below the 200 week simple moving average. The last time around, the price in the bear market of 2022 in late 2023, although it took several months for the price to go below the 300 week simple moving average, the major bottom was below the again there was a double bottom, but the second iteration of the bottom, the price went not just below the 200 week but below the 300 week moving average, also the simple moving average. That's when the green line turns red. This time around, in 2025, the 200 week and the 300 week simple moving average were essentially coinciding together, and that is very normal for assets which spend a lot of time in a range bound scenario. And now the 300 week simple moving average is also at around 13.45 cents. The 200 week is at around 13.60 cents. So both the currently the price is below both 200 week and the 300 week simple moving average. That's the first pass to identify if the asset is in accumulation phase or not. So coming to the other analysis, now that the trend is broken, the trend of essentially higher highs and higher lows till October 2025 for Doge was essentially broken in late October. Now the trend line would likely act as a resistance. First, the major resistance is the 20-week simple moving average for Doge is at around 14 cents. If there is a bottoming pattern somewhere over here, that would be if Doge finds bottom at the current risk levels or the current levels or the price levels, that would be akin to the bottom in June, July 2024. So 2 years later, if that bottom were to hold, again does not look the most likely scenario. The most likely scenario is again going back all the way to the 2022 bear market lows, or if not that macro bottom, just ahead of, sorry, just above that 2022 low or closer to the 2023 lows at around 6 cents is what is the most bear market bottom related scenario. You can check it out in terms of the monthly candles, and there is still some air gap between the lows of 2022-2023 bear market and the current price. So coming to the our own website, back to analyzing what happens with Doge's individual risk based model, starting with the time weighted average price risk, which is one of the major components of the model, of the overall risk score model. This is again similar to the 200-week simple moving average. This blue line over here is informed by how much time a price has spent at some of the key levels. And again, it's not just average price, which is just simply an average of, let's say, look back of certain thresholds of time, or based on, like, for example, 20, look at last 20 week, 50 week, or so on. This is since inception what has been the time spent at some of the key price levels, and that informs what is the time weighted average price. So just an average price would be, for example, if an asset spends 900 days at $1 level and 1 day at $900 level, uh, roughly speaking, the average and the time weighted average price would differ in such examples as. So the time weighted average period would be the time spent, that is the 900 days in $1 range, and the last day at 900 range, and it would influence the time weighted average price in favor of the time spent at some of the higher time spent at lower level than, let's say, for example, simple moving average, where the price would be, in an example, if the price would be $10, $100, $100, and $100. So 4 years at $100 and 1 year at $10. You divide those, it would be adding the 400 and then 100. Sorry, 400 plus 10, that is 410 divided by 5. It would be $82. But if, let's say, something similar were to happen i- i- for for the time weighted average price perspective, where an asset spends 7 year at $10 level and 1 year at $100 level, its total would be, um, the total average would be 170 divided by 8, would be $21.25. So that's the difference between frequency counts as a um, raw number, whereas time weighted average price is more focused on the time spent at some of the key risk levels. So this over here again, influencing the time spent at some of the key levels. Whenever the risk level over here is in this risk level 1, that means the price versus the time weighted average price difference is either minimal or less than 0. That means if the price is lower than the blue line, which is the time weighted average price, accumulation in this territory, not the worst idea. Right now the price is slightly higher than the time weighted average price. There is a difference of about 7%. The time weighted average price for Doge is at around 9 cents. The bottom last time around for Doge was close enough to the time weighted average price to check if this time around, if the time weighted average price bottom holds. This model says that in a scenario where the time weighted average price model holds as support, the macro support, then the bottom of Doge is really close to the current price. If there is some further deviation, like it was in 2018, 2019, at one point over here there was a difference between the price and the time weighted average price of about 55%. So if we go 50-55% lower than the current price, then that era, in terms of the price action lower from current price, if the Doge price were to go to 50-55% lower, then this floor for Doge would be slightly under the 5 cents level, which is uh, current from the current price is at a 55% drop, or slightly less than 0.05. So that's the worst case scenario for Doge in terms of the time weighted average price risk. The DCA, or the regression model, says that the accumulation risk right now has gone down, as the fair value for Doge is at around 23 cents per this regression model. The better way to look at it is this, using the heat bands. Again, same fair value using this polynomial regression model tries to cut the price action into two halves, one bullish and bearish. The bottom is bearish. If we look for some macro support for, or macro indicator for Doge accumulation using one standard deviation residual on the fair value, so slight undervaluation, slight more undervaluation than the fair value, This support for Doge was at around 8.5 cents. So the price did come to that level in February 2026. That was the bottom, the initial bottom. That does not mean that the price cannot go lower than that. There is always a chance that it goes to the 2 standard deviation floor like it did in March 2022. If that were to happen this year, again, right now it's at around 3 cents. But I would imagine as the year progresses, this rising function could go somewhere close to that 4.5 to 5 cents level. This is that drop I mentioned previously. So that is where the 2 standard deviation drop. If there is a panic in the wider asset class or the macro environment, the price of Doge could be somewhere at that level. In the 20-week simple moving average price risk, again, we are just going through each model of that composite risk score. This model says the bottom is in, as you could see that this model tries to identify bottom early on. It does get it wrong in the initial drop of the bear market year, like it got it wrong in March 2022. It said that this model identified bottom at 12 cents, but the actual bottom was at around 5 cents. Nonetheless, after the price goes to this plum risk level, less than zero point 0.1 risk, there is at least one major counter trend rally following that before another series of drops occur. So right now the time weighted average price risk is low, the simple moving average price risk is low, and the regression based price risk is also low. So all the three models, you can see the risk levels are getting low as we speak. So what remains a challenge in identifying this treacherous market is this machine learning based price forecast, and what could theoretically be a bear case if, let's say, the bear market stays with us for 3 to 4 more months. Again, those months could be either in the first half of the 2026 year or in the later half of the year. Timeline to be decided, but from here, if there is a drop of 3 to 4 months, the bottom for Doge in that environment is, per the machine learning model trained on price action since 2017 at a weekly average level. This looks at the seasonal ARIMA based interpretation and LSTM based interpretation of what the bear market bottom could be using standard deviation residuals or standard deviation based confidence levels. So this model says that in a non-panic bottom case for Doge, the bottom for after 3 to 4 months of bearish activity is at around 5 cents, which is again close enough to what we discussed over here in that time weighted average price based extrapolation, as well as the machine learning based extrapolation, as well as the regression based extrapolation of the bottom. So three different models pointing to that level. So that's the worst case across the three models. So as the price is again still uh, 50% away from that level, that means the overall summary over here, if we were to look at the overall normalized risk summary, although it's closer to the bottom due to the price falling below the 20-week, 100-week, and the 200-week simple moving averages, that overall risk per the technical analysis is low, but per some of the other models such as the time weighted average price deviation, the DCA 2 standard deviation residual, or the regression based 2 standard deviation residual, is still about 40-50% away from the current price. If we were to look for any market base case, bear market bottom is about 12% away from the current price. The base bear case for Doge per our per our risk based models is at around 9 cents. By the way, all of these models are available on the website cryptoweeklies.com, link on the bottom of your screen. So if you enjoy this content and want to stay updated on what these models says throughout the year 2026, all of these models are live and get updated every day based on the latest price action. So it's not a stale model. um, the panic case scenario without a macro recession for Doge is at around 30% down from over here, the 7 cents. And the blood case scenario, if something goes majorly wrong, the price could have a floor at around 5 cents. So that 5 cents is still within the cards. But if we want to close on a bullish note, if let's say the market eventually recovers and the price eventually finds a moon case, or let's say Doge achieves that meme coin status, the not the major meme coin status, like it enjoyed for several months to years in the crypto asset class, then the base peak in the next bull run established by this risk-based model is at around $2.50, which is about a 25x of the current price. So that's a serious 25x. Again, not financial advice, but if let's say Doge goes to above a dollar level, it did not go to beyond the 74 cents like that it achieved in May 2021. So again, take it with a grain of salt. And there has been this from the peak to peak, what you can say under this lower trend line valuation. So this could be again in 27, 28 time period. If we go by this peak to peak interpretation of what the next peak in 2027, 2028 period could be, somewhere between 25 cents and 30 cents. That again, from a 5 cents floor, would still be a 5x of the current of that potential uh, peak from bottom to top for the next bull case scenario. With that, I would like to conclude. Hope you enjoyed the content. If you did, please give a like and subscribe, and hope to see you again tomorrow. Thank you and have a nice day. Bye bye.